right?
Yes, there's the mutual fund data that has come out for the month of December. The equity inflows look pretty good at the moment.
Yeah.
So, Pavitra, did you take a look at them?
Yeah, it looks a lot better. I mean, remember last month we did see quite a contraction, but this month is coming at around 7,200 crores. This is versus the 2,200 crores that we had last month. That is for the month of November. I was actually looking at the large cap funds because, you know, last month there was quite a contraction there. We saw a near 1,100 crore outflow in the large cap funds. For a first time in a while, right? So there is a contraction once again, not as large at all, but around 26 crores of an outflow. So it is still a negative figure. That is what has come in on the equity funds. I'm waiting for more details, and let's see if I can get a few more. Yeah, okay. So the net equity inflow is at 70 to 80 crores. This is versus the 2,200 crores that we had. The debt scheme outflow is at almost 22,000 crores. This is versus the 3668 crore inflow that we saw. So do keep that on your radar as well. Those are the figures we have for now. I'm also waiting to see what the balanced advantage fund outflow looks like. I mean, there has been an outflow for the past 2 months. It'll be interesting to see if that is, you know, a theme which is continuing as well. We're going to try and get you some reactions. In fact, Sunil Subramaniam is also joining us now. He's MD and CEO of Sundaram Mutual Fund. Sunil, good morning. Thanks a lot for joining us. So it looks like, you know, we do have once again quite a positive net equity inflow number. It's coming at around 7,200 crores. There was a contraction last time, but how are you looking at this? Because, you know, while this number looks positive, there is once again an outflow in the large cap scheme. So how are you reading this?
No, I think that basically the December month was where there was a little bit of profit booking, and naturally that's more on the large cap because valuations had run up. Because if you saw July to November, FII flows had returned very strongly to Indian market, and valuations had risen up, and that was more oriented towards the large caps because FIIs naturally focused there. So the sharp rise in those valuations meant that people who had invested in large caps a few years ago saw that it's a good time to book profits, and some of that is spilled over into January too. So I would say this is just more profit booking at this point in time, but otherwise flows across schemes I think are quite healthy, fresh inflows.
Okay, flows across schemes are quite healthy. In fact, you know, we have been talking to a whole host of experts on the large cap picture, because that has been sort of that's also where we've seen sort of, you know, the outperformance has not really come in, right? So, Sunil, just a question on the large cap schemes. You know, since we're talking about this, there's been this huge debate about the passive versus active investing in large caps. Are you also part of the group that believes that large cap investing is better done with the passive schemes?
No, not really. See, I would say that it depends on if you're an institutional player where even small amount of cost differential makes a difference and you're going to be churning your portfolio in and out, then passive makes sense. But if you're a HNI or a retail investor with a longer term outlook, you see the reason that in the last few years there has been this passives doing much better than actives in the large cap space is partly driven by the fact that a few stocks in the index have rallied a lot, and those are either not held by fund managers or not held to that extent because of regulations. So there has been a bit of a challenge for active fund managers in the past, but I don't think the next few years are going to replicate that entirely, because I see that as action shifts to domestic economy, you will find that there's far more value to research of fund management and delivering that value as opposed to do purely a liquidity from overseas driven rally. So I think I will say that yes, large caps will be the ones which are most under pressure to beat the benchmark because of ETF flows, but that doesn't mean that there can be no alpha. I do believe that over the next few years we will see alpha returning. So I'm not fully in the camp of saying didn't large caps do only passives. No, I think a blend of the two is what I would recommend.
We're talking about, you know, some of the Adani Group stocks, right, that led to a big outperformance in the passive funds versus active. I mean, I take your point entirely. I wanted, and I mean, for the sake of fund managers, I'm hoping that they can generate alpha in the year to come. I wanted your thoughts on hybrid funds. After many months of an outflow, there's an inflow this time, I think 2,255 crores. Your thoughts here, and what is the, prognosis now?
So I think that hybrids tend to get more money when the volatility increases and there is this doubt about equity debt asset allocation. So some people who get doubts in the head then tend to go into a hybrid where the fund manager takes that call. So over the last few months, right before this month, you saw that equities were rallying very strongly. So lots of people felt that better I'm putting in a pure equity fund and taking that, and why take any debt exposure even in an hybrid. But given the valuations that rose over the last till November, right? Now this month you're seeing again that those valuations becoming something that an investor starts thinking about, and he says, should I put more in debt? Then one of the options is that to do it through the hybrid, where the fund manager chooses the right amount of debt, the right maturity duration of that debt, and the lot. So I think that as debt becoming more attractive with better long-term yields, right, some of the investors feel that playing that through hybrid is better, because then tomorrow a situation comes where equity valuations look comfortable and you want to increase it, you're not left with that decision at your end, but the fund manager can take that easily with no taxation impact at your end. Remember, an investor making an equity allocation and debt allocation has to constantly keep the 3-year taxation for debt and the 1-year taxation of equity in his mind when making these decisions. So hybrids as a category, until valuations come back to a reasonable level, will, I think, from this month start getting increasing allocation.
But then, Sunil, how would you explain what's going on with the balanced advantage funds? This is the third straight month of an outflow that we're seeing there. Initially, when we started seeing an outflow, the sort of reason that I got from the entire industry was that, equities are looking so attractive, so maybe people are going for pure equity funds, and that might be a more attractive. But, I mean, clearly you're saying debt is attractive, so why is that not showing through in the balanced advantage funds? And is this a trend that you expect will continue? I mean, the outflow from this category.
Yeah, but isn't that logically following? Because what's happened is in balanced advantage funds, the balanced advantage managers have been increasing the equity allocation and reducing the debt. So clearly, when an investor feels he wants more debt in his portfolio, he feels that I'll pull that out from balanced advantage and take 40% debt if I need to, because balanced advantage is running at 60% of equity, 50 to 60% equity, another 10 to 15% in arbitrage, and only the balance is going to debt. So the debt component of balanced advantage is very low, and ideally, if an investor feels he should have more debt today, then it's better that he does it on his own, right? And that's why he pulls out from a BAF and tends to put debt allocation on his own and equity on his own. Right? And second aspect is in the BAF is that the fund managers tend to keep the debt short because they want the flexibility to keep switching from debt to equity.
Right.
So if they take long-term calls, there's a mark-to-market loss risk. So they keep a short-end debt. Whereas if an investor, you want to lock into a long-term yield, you're better off pulling out from the BAF and putting it into a medium-term duration debt fund or a target maturity fund.
Okay.
Okay. We have Anthony Heredia as well, who's the MD and CEO of Mahindra Manulife Mutual Fund, who joins into the discussion. Anthony, what are your thoughts? There's a net equity inflow this time of over 7,280 crores. What is your takeaway from this? And given that we have such a volatile market environment upon us, what is the best way to approach it now?
Surya, I think, the flows continue to be robust. I think investors continue to invest. I think what you're also seeing, and this is a trend for the last few months, is the number of people wanting to take some money off the table is increasing month over month, right? Which is why the net flow numbers look what they are. I think volatility from our perspective is here to stay through 23. And so I would expect net flow numbers to remain at this range, at least for the next couple of quarters. The only silver lining I can see is, after a couple of months of small and mid-cap funds not seeing too much of flows, I'm seeing some very interesting, strong numbers in that segment. So that's a positive. I would expect the trend on fixed income to start to turn. I can see a lot of commentary from us and a lot of our peers talking about investors needing to allocate towards fixed income. I think one of the realities is that fixed deposit rates are obviously at their highest at this point. So that's a challenge. But I think you will find that over the next few months, we will see flows remain in this kind of range. And I would believe that balanced funds and fixed income funds will start to see some flows. And that will be a consequence of volatility. And I think it's a consequence of the investors' view on valuations in the market.
Okay, got that. Anthony, good morning and thanks for joining us. This is Pavitra. So you were saying that, you could see the fixed income space gets more inflows. Can you tell us what it is you expect? I mean, we've seen around 22,000 crores this time around. how much of more inflows do you expect in this space going forward? Because this has been picking up anyway slowly, right? I don't know if you heard us talking to Sunil earlier. He is saying that people seem to be pulling money out of the balanced advantage funds and going for a more like pure debt kind of play. Do you think that's what's happening as well?
So some of the outflows from balanced advantage, I think, has a relation with that being a category that actually got the most flows in the last 24 months, right? So if somebody's looking to take some money off the table, that's one of the spaces he or she will look at. I think from a fixed income perspective, obviously target majority funds have had very decent flows for a while now. But I think they face severe headwinds from alternates which are fairly direct, which is fixed deposits. I think the story for fixed income that we're able to talk to investors about, that perhaps rates are peaking out, and from a 3 to 5 year perspective, it may not be a bad idea to invest, is getting more and more resonance, right? And I think eventually that will see people cutting checks. I think people today are nodding in appreciation at the logic of the argument, but they're not cutting checks. I would suspect over the next couple of quarters, you'll see some people cutting checks. The other thing I think we should not forget is I think the average Indian investor in funds is getting more mature. I mean, take, for example, the flows into arbitrage funds. After 9 or 10 months of significant outflows, investors see the returns coming back in arbitrage, and that's also seeing significant inflows over the last month or two. So my suspicion is that the divide between, let's say, investment rationale and actual flows with fixed income will happen in the next couple of quarters.
All right, got it. With that, we're going to wind down this conversation. So Anthony, Sunil, thank you very much for joining us and breaking down the mutual fund data for the month of December for us. We're waiting by for the SIP figures. The call is at 12. The AMFI call is at 12. So we will get that figure in a few minutes. But, overall, equity inflows looking good. There was some profit taking that we saw last month. That figure once again has picked up. Large caps have seen an outflow, but the outflow is much, much lower than what we saw last month. And the debt fund continues. It's around 22,000 crores in terms of the figure for the debt funds. That's what's going on from the mutual fund space. We're going to get into a short break, but when we come back, we'll put the spotlight on the autos. So stay tuned for that.